This new budget showed you that the Republicans aren't going to cut anything. And so you got the debt GDP at 125, 130%, going to 140%. That means the total debt will go from 36 to 40 trillion. They're going to have to print money to get out of this. But now all these Western countries, everyone's got to print money together. Gold probably has to reset on at $15,000 or $20,000 ultimately. One thing about the book, I talk about maximum pessimism. The juniors really are a maximum pessimism sector right now. There's so many juniors trading out a couple of dollars ounce for gold, or 50 cents or $1 per ounce of silver. They really are cheap. I think we're starting a market that should at least be 3-4 years up in the juniors.
Hello again, everyone. Welcome back to the Daily Gold YouTube channel and another episode of the Daily Gold podcast. We've been fortunate to have some great interviews lately. We're going to continue that today in this episode with my old friend. He is David Skryka, the author of many books. His first book was written in 1998 titled Stock Market Panic, predicting the coming bear market in U.S. stocks in a new commodity bull market. And obviously that was a brilliant prediction, brilliant timing on that book. He's written another book. Here you go. You can see that. Mega Returns, Profit from Maximum Pessimism. Love it. David, my friend, Mega Returns. Are we about to see that in precious metals? Are we about to see that in junior gold and silver stocks? I haven't asked you directly about that, so what do you think?
Well, what I was telling you off air when we started was what's so funny about that first book, which I wrote when I was only 21. I'm 47 now, or it was got published when I was 21. I think I wrote it in 97 because I was getting worried about the valuations in U.S. stocks. So like basically what's so funny is it's almost like full circle where, yeah, in the 2000s, as I predicted in that first book, gold stocks really underperformed, equities underperformed. Gold and gold equities did fantastically. Commodities equity did fantastically. Emerging markets did fantastically. But then in the 2010s, and I think like quantitative easing and all that sort of thing played a big factor in this. In the 2010s, basically, we saw gold equities, we saw equities really do well in gold, and gold equities do poorly. And now we kind of come full circle where now the gold and gold equities look like they're breaking out. And I think, like, even though I know we've had this huge low rally off the lows in the stock market, I still think we're in some kind of topping pattern in the stock market. I don't know if the S&P goes to 6,500 in new highs, or if it kind of fails below the old highs. But I think, like, with market cap to GDP being 200%, et cetera, I do think we'll roll over, and just like the 2000s or 1970s, we're going to see the gold and gold equities really outperform. It just took, way longer than I thought. Cost probably me and you a lot of money, and probably a few years off our life, and due to the stress and depression and all that stuff. But I really think finally, like I was also saying off air, CDNX had a very key resistance at 650, going back to like 2022, and we broke that recently, and now we're at like 720. And you go look at that CDNX chart, really. There's not much in terms of further resistance till about 1,000 on the CDNX. Maybe, I think that's at the 2020, 2021 highs.
Okay, I want to pin you down on this because you didn't give a direct answer, but you set the scene very well. And I know because it's with gold and silver stocks, there's a lot of cheerleading, so people get tired of that even when the argument is really strong. How do you see the next couple of years unfolding in these juniors? I mean, could we go into a mini bubble here, or is this just going to be a garden variety bull market?
I think the one thing that could help is I still believe, even though crypto held up pretty well during the low, so crypto was interesting, Bitcoin was interesting because it fell. I'm getting somewhere with this, just so you know. It fell early on in the correction when the correction wasn't really that bad. And then it held up when the correction got really bad in April. So I actually had a small short on crypto, and then I think I made 1 or 2% on the trade and then got rid of it, because I could tell it wasn't falling, right? But I think if crypto acts like it normally does in a bear market, say Bitcoin goes down 50%, the NASDAQ goes down 30%, I think a lot of that crypto money will then move into juniors, move into gold, because that's speculative money, right? And if the sector is hot and doing well, that could drive inflows into it. And I think that will really, really help the sector going forward. And 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 you gotta understand, like one thing about the book, I talk about maximum pessimism. The juniors really are a maximum pessimism sector right now. There's so many juniors trading out a couple of dollars ounce per gold, or 50 cents or a dollar per ounce of silver, and they really are cheap right now going forward. And another thing that's helped is oil is kind of stagnating in the 60s, and that's a big input cost. And a lot of labor cost increases that happened after COVID with the big inflation have also kind of plateaued. So their input costs are kind of now flattening, and the cost of like what they're making is going way up. So I think that will trickle down to the junior sector. And one reason I think is these senior companies are going to start looking for properties to take over, to expand their production, to expand the amount of ounces they have in the ground. And the juniors are still pretty cheap, right? And now one thing I'm sure you've noticed too, because I think we both participate in some private placements and that sort of thing. One thing I've really noticed is companies are having a lot easier time to raise money now. It's not a grind like it was, like 2 years ago.
Yeah.
So,
And I like,
long story short is, yeah, I think we're starting. It's kind of how I felt in 2002, 2003. I think we're starting a market that should at least be 3, 4 years up in the juniors.
no, 3 to 4 years. Yeah, that would be fantastic.
That's a least. That's a least.
Right. And I guess not to, not to, and I'm not asking leading questions here where, I'm trying to get you to confirm everything I think. But, getting back to the book, because you talk about really, we're in an everything bubble almost. And sometimes I think gold and silver, like they get lumped into that, even though they're not, because they only
Yeah.
started moving really a year or two ago. But yes, you look at everything else, like you said, crypto, stocks, real estate, this everything bubble. I mean, I kind of think that gold and silver, like they're the ultimate, like George Soros said, it's the ultimate bubble. Gold's the ultimate bubble. I feel like that, that's going to end this whole monetary system. Like it's going to end in the next decade with gold and silver in this massive bubble, this mania, after the other bubbles have crashed. So how do you think of the alignment between, okay, gold and silver are really just starting their move now, other hard assets as well, but then you have all these other things that are basically at the end of their secular trend, real estate, stocks, but bond market's already in a secular bear. So yeah, I don't mean to drone on here, but how do you see the interplay, if there's anything there at all?
Well, like, yeah, again, if you go back to the 2000s, which is similar kind of to the 70s decade, where you had these commodity bull market and equities lagging, is like when there was like the really sharp sell-offs near the end of the bear market in equities in 2002, the gold stocks would get a little whacked with the rest of the market right near the end of the sell-off, but mostly they were going up all through '01 and '02. And I think that's really what's going to happen now is that, like, if the market does kind of start to roll over, you will see the gold equities probably catch a bid in a fear trade. And then maybe when you get those big capitulations, with days the markets are down 3, 4, 5%, because they're going to get whacked with everything else. But then they'll be the first thing to come back. Because here's another thing that's interesting, that when you have those kind of capitulations, and then the Federal Reserve cuts rates and prints money, and you go, like, again, you go back to 2002 or you go back to 2008, the gold equities perform, or 2020, the best out of those lows. So I don't think, I think it's going to be more like, again, '01, '02 or the 70s, where like the gold stocks are almost going to trade contrary to the stock market. But like I said, when there are those big drawdowns and everything, they'll probably get whacked at that time. And I always tell people, I've been saying this over and over again, don't chase. Like, don't, you buy the dips, sell the rips kind of thing, especially if you're just trading the stocks. You definitely when the, like right now, I wouldn't be buying anything. I own stuff like Avino Silver and New Gold, which have both done fantastically. I ain't buying them here. Like, if anything, I would take a little money off the table here and then wait for another dip. That's just trading money, though, because I think now we're finally in a position like '02 or '03 where the gold stocks can actually, like I said, go up for a few years, and the juniors can go up for a few years, and you don't have to just, you don't have to just think, okay, this is a 6-month move or a 12-month move. And part of the reason is the macro backdrop. When the debt to GDP is 125%, and this new budget showed you that the Republicans aren't going to cut anything. And so you got the debt GDP at 125, 130%, going to 140%. That means the total debt will go from 36 to 40 trillion. They're going to have to print money to get out of this. And you're seeing that the TLT and or whatever long-term interest rates aren't really going lower. And part of the reason I think they aren't going lower, even with the Federal Reserve probably going to cut a couple times this year, is because that debt load is so huge. And probably at some point, the Fed will have to come in and buy that debt. And that's extremely positive for gold. And remember, this again is not like '07, '08. And that back then, the debt to GDP was 60%. Now it's basically twice that. And actually, most countries that start these debt crises start around 130, 140%. That's when it gets bad. And the only reason that the US hasn't entered that yet at 125% is they're the reserve currency. But I always tell people the US government, the way they're running the budget, they're essentially a banana republic country at this point, right? It's like if like Honduras was doing this, the Honduras currency would be collapsing and inflation would be exploding, you know?
Yeah, and I was that was actually going to be my next question because you've been texting me about this over the last 3 or 6 months periodically about how it looks like we're going to come into a debt crisis at some point. Now, can you walk us through how that's going to look exactly? Now, I think the key you mentioning there, the key point is at some point we're going to have to basically print money to buy our own debt and keep interest rates down. But kind of take me through how the debt crisis will materialize and then intensify moving forward.
My own personal opinion on it is what's going to happen is that after this budget is approved, and then the deficits are obviously like they forget 2 trillion. I think it's going to be closer to 2.6 trillion this year, which is almost 9% of GDP. During like, I know we had a small contraction in GDP in the first quarter, but we're still technically, an economic expansion, right? Unemployment's 4%, stock markets are all-time highs, et cetera, et cetera. I think when it's obvious that this debt is going to continue to explode, investors are going to ask for more return on their money, and the bond vigilantes, as they're called, will come out and they will sell the debt. And because Powell and Trump obviously don't get along, Powell's not going to start QE or buying debt until he absolutely has to. And I think that's what will happen. Another issue is not just selling the debt, because of all this rhetoric over tariffs, over whatever, foreigners are not going to buy US debt right now. But I think that's one other reason I think gold is doing great. Because I think the big money, the sovereign wealth funds, the central banks, they're the ones buying gold right now, right? Because they're not buying the 10-year US Treasury bond, which they might have in the past when the economy's slowing or things look like they're going to get bad. I think like basically now, like these policies have isolated the U.S. and countries don't really care at this point. And I don't know if you know anything about the Suez Canal crisis. When the UK tried to like go into a war with Egypt because Egypt was nationalizing the Suez Canal, and the U.S. gave the UK an emergency bailout loan after World War II, and then basically said we're going to dump all your debt if you don't stop that. And I think if some kind of foreign venture like that happens, or like I said, just the debt gets too big, I think that the foreign investors are going to punish the U.S. For doing that. Because like I know they had some minor deal with China recently, but like, do you think that China's going to want to buy any U.S. debt now that they have 50% tariffs and all this stuff going on? That no, they're not going to care at all. And like and when you're calling, you're telling Canada they're going to be the 51st state, or you're ripping on Europe all the time. It's like you've basically pissed everybody off, right? And those foreign investors are at some point just gonna do the big F you to you and dump your debt, or like I said, not buy it. Remember, approximately 8 trillion of that 36 trillion is owned by foreign investors. So, and a lot of that debt is mostly 1-2 years in duration. So they don't even have to dump it. They could just say when that 2 years comes up, well, we're not renewing that. And that means you got to find new buyers, right? And not, if you can't, it's, if there's more supply than demand, that makes rates go up too. So that's how I think it's going to unfold. Bond vigilantes, foreign investors not buying, maybe even selling, etc.
David, is this something that could happen regardless of what the economy does, like in the next year or two, or if the economy, let's say it's slowing and it's really rolling over, could that make things ripe for a debt crisis?
I still think we're going to have a recession. Forget it being terrific. The problem with that whole thing that happened in April in the markets, it was kind of like an artificial decline, an artificial rebound, because they did those crazy tariffs for a few weeks, right? Which in my opinion were essentially madness, right? And then they did that, and then the market kind of like sold off, saying, I don't know, we don't know what's going to happen. And then the market kind of rebounded now that everything's kind of been retrenched a bit. So I think the market, this is where the market kind of would have been all along if we didn't see that decline and then increase. And yeah. And then like I said with the foreigners, like with the debt market, yeah, I think the issue is if you get a recession. And remember, we had a inverted yield curve and went positive. This is answering your question. And every time that happens, you get a recession. So if we get a recession, forget everything else. That means forget the budget that they pass, etc. Tax revenues are going to go down, and spending is going to go up even more. And if that deficit blows out to 3 or 4 trillion, I think, yeah, that's when the you know what hits the fan, right? And that's when this can happen. And again, every time the yield curve has gone from inverted to positive in the last 45 years, it's only happened 6 times in the last 45 years. Every single time, though, a recession followed within the next roughly 12 to 24 months.
Yeah, and so it seems like that could be a time when gold and silver just like really accelerate to the
Yeah.
upside.
And like I said, like the difference between now and the 70s or these other time frames is, again, the US. See, when the UK was the dominant superpower and they went bankrupt after World War II, you kind of had the US fill that void. But now all these Western countries, the countries in Europe, Canada, Australia, they're all essentially bankrupt because of the huge amount of social outlays and the size of the governments and size of the debt. So it's like everyone's got to print money together. And what does that do to this whole system, right? Or monetary system, etc. And it's like gold probably has to reset on at 15 or $20,000 ultimately to
Yeah.
reset that. Now I know some people have told me they think that Bessett guy has a plan where he wants gold to go like 15,000, you know, and then he'll sell the gold to actually pay down some of the debt. They actually want that, right? This is what people tell me. I think it's BS, to be honest with you, because I worked it out. I was like, look, if gold goes to 15,000 and the current reserves that U.S. has, they only have 4 trillion. So what? You're going to pay off 10% of the debt? That's not going to do anything. So you need gold at like 100,000. And if gold's at 100,000, here's two things. Number one, you're in hyperinflation at that point, probably, right? Or super high inflation. And number two, why would you sell your gold to pay down the debt? And why don't you just keep the real asset and just pay down the debt in like useless, worthless paper money? That would make way more sense. you know?
Yeah, absolutely. Um, okay, what else do I have here? Yeah, what I don't have a good transition, but I mean, let's stick with commodities. Other than, I mean, it sounds like you think gold and silver over the next couple of years they'll be the best performers. But what other commodity or sector do you think has a lot of upside or something close to that, if any?
Like I actually wanted oil to fall into the 40s or 50s, but it does look like it's turning around. And there are some very good cheap oil plays out there. So maybe oil can go back into the 80s or 90s or something like that. I really like platinum and palladium are looking like they're catching up to gold and silver now. I like them a lot. And I have to say, even though I'm not a huge fan of EV and solar and all these green technologies, it does look like lithium is finally bottoming as well. The issue I have with lithium, though, is the companies are mostly garbage. Like you have ALB and it's got a couple quality large caps, but all those Vancouver guys who turned their gold stocks into lithium stocks 5 years ago, like those companies are sorry, they're mostly just crap. So that's the problem. There's a really lack of investments you can make in lithium. But I do, like, if you're talking maximum pessimism, go look what the price of lithium has done. It's off 80% from its highs. Like I said, ALB, the kind of leader in the sector, is down from 260 to like 60. So it's pretty cheap down here. So yeah, I like oil and gas. I like platinum. I like palladium. I like some of the agricultural commodities, but they're more like trades. So you want to look for one that you don't want to chase cocoa when it went up like crazy. So you kind of want to wait for them to get beaten up and turned around. So actually, I have an oil and gas company that I just recommended recently as well. So, and what you have to ask yourself too, Jordan, uranium has turned around a lot too. Again, the issue I have with uranium is similar to lithium. Most of the companies are not quality. You got Cameco and then a lot of junk. And I know there's some there are some good mid tiers in uranium, but they're not the greatest companies in the world. But why is uranium? Why is lithium? Why is oil and gas? Why are all these other commodities, platinum, palladium, starting to join? And I just think they see the problem with the deficit. There's going to be more printed money. And also the tariffs are essentially, I know the last inflation report today was pretty weak, but the tariffs longer term are going to be inflationary. Because now basically it's set that China is going to have 55% tariffs. And like I have this little air conditioner behind me right now. It's like one of those little portable roll ones, right? I bought for $300 on eBay. I didn't know where it was from, and then it was from China, of course. Well, that was $300. Now it's going to be almost 500, right? So that's going to be inflationary in nature. It's a tax, and then all the minimum tariffs, even on the countries they're going to do trade deals with, are going to be 10%, and again, that's going to be inflationary. So I think the reason you're seeing these commodities rock is that the market is starting to discount. Forget that inflation has kind of weakened the last few months, that it's going to start to take off again. And as you know, last thing I'll talk about, if you want to talk about this yourselves, the 1940s, the 1970s, all these decades with inflation, there's two or three spikes. There's a spike into the double digits, and then it comes down, and then it stays there for like 6 months, a year, and then the next spike begins. And usually, like I said, usually there's 2 to 3 spikes.
Yeah, no, that's great historical information. Last thing, getting back to the book, I think this is a really important point. How basically you talk about how, crashes, bad bear markets, they're always followed by a bull market, at least for a couple years. And like that's where the real opportunity is, because, you listen to interviews on YouTube and all these channels, the doom porn, the crash porn, it's just endless. And I don't think any of them, maybe a few of them, but it seems like most they don't say, yeah, just go in cash, wait for the market to crash, wait for a bear market, then you can buy. It's like the majority of all the crash, crash, crash. It's macro doom, crash porn, and nobody ever talks about, like you do in this book, the great opportunities. The market, and you don't have to get the market. You don't have to buy at the exact bottom.
And that's
But
always the
go
tough.
ahead. Yeah, tell us more about that, because I think it's so underplayed. What happens after the crash?
Crash. Yeah, because no one talks about how, like, I bought Tata Motors in 2009 at 350 a share, and I sold it, I think, around $30, and it ultimately went to $50. And actually, if you adjust it, you can't trade it now. Unfortunately, as a North American, they delisted from the U.S. and it only trades in India, right? Which tells you something, by the way, what's happening in the global economy. The Tata Motors, which owns Land Rover and Jaguar, right? They're like, we don't even need American investors anymore. Like, we're fine just trading in India, right? So anyhow, and then if you adjusted it in the rupee, value went to $100. Yeah, in the last few years, right? So that's what people don't talk about. Like Las Vegas Sands, a casino company, it went to like just over $1 after the financial crisis, and it rebounded to like $50. Like, this is the kind of things you can get. And one thing I talk about in the book, and I talk about this in my newsletter as well, is Maybank Faber, not Mark Faber, right? But Maybank Faber runs some ETFs in the States, did a study on what happens when assets fall 60, 70, 80%. And basically the average 2 to 3 year return is like 100, 200% afterwards. And just look at it this way. Like, there's a stock I bought that was a hot stock 10 years ago recently at 60 cents a share. And I can't name it because it's for my subscribers, right? But it was $100 at its bubble peak like 10 years ago. And now it's 85 cents. It's already up 40%. But it's simple mathematics. Like, it's going to be very difficult for stocks like Nvidia and Apple to double or triple from here. But if you can find one of these beaten up companies that's fallen from, I don't know, $20 to $1, if it just rebounds to $2 or $3, you made 100 or 200%. So it's not even just pessimism or whatever. It's just basic math, where as long as the company is not going to go under and it's solvent and there's a catalyst for it to turn around, it's a lot easier for you to make 4 or 5 times on your money. And actually, I'll give you a perfect example with Amazon. This is like pre the split. Amazon peaked at over $100 a share during the dot-com bubble, and it fell to 5, right? And I think with the split, that was like going from 5 to 25 cents, right? I'm just going to look at Amazon right now and just typing it in as we speak. And okay, even if you bought at 5, you would have done great, right? Because it's $200, $213 a share. But imagine you could have bought Amazon at 25 cents. You'd be up like almost 1,000 times on your money. And that's one of my biggest regrets, that I didn't do that in 2001. Or even if you didn't get the exact bottom, if you bought it at 50 cents, whatever. So that's what I'm trying to say, though, is that Amazon was still a great company. It still went up longer term. but you would have much rather bought it at 25 or 30 cents than at $5, right? Yeah, you didn't have to go through that 90% decline. And it's always easy, like 2020, 2020 hindsight, all that thing. It's like, yeah, okay, if I would have bought Amazon, oh, I should have just bought it and held it for 25 years. But how many people can handle a 90% decline, right? Not too many when you're seeing that happen in your account. And by the way, one reason you get maximum pessimism, these opportunities as well, no one really talks about this part of it, is a lot of people in a recession, they're losing their jobs, they're losing their income, they're losing their cash flow. So they're almost like forced to sell some of these stocks just to live off that money before they can find another job. And then if you're someone who has a stable income or has like cash in the bank, you can take advantage of that. I know that maybe sound morbid or something, but that's kind of what happens, is that a lot of that forced liquidation is just people selling so they can like keep alive basically, right? And then you can take advantage of that. And I'm sorry, that's just the nature of capitalism and markets. Like, it's like, I think I've talked to you. I'm a big Trailer Park Boys fan. It's like Ricky would say, survival of the fitness.
Yeah, and I guess to piggyback on your point, and you're talking about buying like blue chip or near blue chip companies. Like you're not dicking around with companies that maybe, there's a real risk that they could really go bankrupt. Like when you buy the best or like
Yeah.
well-known companies that have crashed, like that like you don't have to get the exact bottom because they will turn around and big funds are going to buy those stocks as the economy improves.
Yeah, well, if you look at kind of like ALB or whatever, it's like that company's not going to go under. It's one of the biggest, lithium producers in the world. And it's like, oh, maybe we'll go to 40. Who knows? But it's not going to go under. And I always tell people too to buy in tranches, right? Like you don't have to buy all at once. Like buy a little bit now, and then buy a little bit in, 3 months or a little bit in 6 months or whatever. And then you get, and let's say the stock starts to take off. Okay, well maybe you only get half the position you want, but if the stock tanks more, you can always average down more. And again, it's basic math. Like, let's say, okay, let's use this like a basic math to make it easy. You buy 100 shares at LB, right? At $64, at $6,400, right? Right? Let's say you buy the same 6,400 and it's getting cut in half from here. Well, then you're buying like 200 shares and your average price is closer to that $32. It's going to be like 40, 45. So that's another thing, is that if you are patient like that and average in like that, you might not get the exact bottom, but you're going to get something like, that's closer to the lows. And just don't be greedy and like buy a whole bunch of what at once. Like recently, I'll tell you a trade I did, as I bought, again, this is my newsletter, so I can't but I bought like a financial services company and it was trading at like 3 times earnings. It was yielding like 8-9%. It was off like 97% or 95% or something from its highs. And the stock has gone from about $10 to $18. So I've made 80% plus I'm getting that dividend, right? So those are the kind of things you can do, as well. Like, like for example, if you go look at McDonald's, they were having all kinds of problems in the early 2000s, and that bear market, they did very poorly. Then McDonald's like basically soared afterwards. It's been one of the best performing Dow stocks in the last 20 years. So like you can use that for junior miners too. Like I said, you look at like junior miners that have like these say crazy valuations where they're trading at fractions of what they should be. As long as the company's going to survive, can still raise some money to survive. Once that market turns, you can make like whatever 20, 30, 40 times on some of these companies. And it doesn't happen very often, but or at least you can make 4 or 5 times, So I think, and I always tell people too, again, with not timing the bottom, if you can make 5 times on your money, say even over a 10-year period, that's pretty good. Like I know like uranium was like that, right? Like if you could have bought Cameco in 2016 and you had to wait forever, but in 2016, I think it was $8. Now it's almost 100, So, you're up 1,200% in 9 years and that's worth it. So, but it didn't really move for 4 or 5 years. So sometimes you have to be like really patient. And that's the problem, just to segue into something quickly before you respond, the newsletter industry. And that's why I've changed my newsletter. I just have a Patreon and I want people who are long-term orientated, because when you write those monthly newsletters, a lot of people just want like the big returns in the next 2 months. And I'm like, no, like sometimes you got to be patient and wait years, and And like, that's the problem with hedge fund industry too. The hedge fund industry is all about making money quarter to quarter.
Yeah, and I mean the real, at least my opinion, I'm sure you agree, the real big money is made by buying and holding over at least a couple years.
Yeah, yeah, because that's what happens. Like, I'll give you an example. One of the stocks I talk about in the book, and I did recently, I did well on, was Fubo, the streaming service. So I basically like crunched the numbers on it because one thing that Peter Lynch used to talk about was if you like something and the service is good, you should consider buying the stock. And he talked about you go into a store and if you see the store is busy as well, these are just like basic things you can do. Well, obviously with a streaming service, there's no store, but I use Fubo because I love Premier League and and I watch a lot of soccer and a lot of football, and I was like, I like the service, the quality is really good, etc. And then what happened with them is they were trading at one quarter of their revenues, okay, and then on top of that, they were trying to do what's called a skinny sports package with the big boys like Disney, Fox, etc. And which is means that like the Fubo service is basically like $100 a year roughly. They want to do a little package for 40, $50 a year where you're just getting NBA, NHL, NFL, Premier League, stuff like that. And they kept saying no. And then all those big guys turned around and they launched a service called Venue that was just doing exactly that. So Fubo kind of said, no, we were trying to do this with you guys for years. You turned us down. We're going to do an antitrust lawsuit against you. So what happened with Fubo is they're growing their revenues at 20% a year. They had this antitrust lawsuit that I thought they were going to win, and they're trading at one quarter of revenues. And the stock had gone from $60 at its top to like $1.30, right? So then they actually settled the antitrust suit with Disney earlier this year, and the stock spiked to $5, and I sold it there. So I made like 4-1 in the stock, and I had options, and I made about 6-7-1 on the options. And basically, I was using this maximum pessimism theory, and then I was also using the theory that like I don't think this company's going to go under, and they had a catalyst. Because when I saw that they're still growing their business, and they have the catalyst of settling this lawsuit that I think they're going to win, you need a catalyst. Because a lot of stocks can stay cheap for a long time if they don't have a catalyst. It's like we know, like some gold and silver juniors can have a big resource, but if they're not going to drill it and just going to sit on it and not do anything, well, even in a bull market, they're probably not going to move. You know.
Right. All right, David. As we close here, tell our listeners, I guess you could buy the book on Amazon. Where can they go to follow your work and subscribe to your service?
I think the easiest thing for everything is just go to profitfrompessimism.com. And we have a link to the book right at the top so you can buy the book. So I have two things going on. So I have like a bunch of tiers of the service. I have a basic Patreon, which is $5 a month, which is a special book offer. I'll probably up it to $7 by the fall, right? And then that's just like one weekly video basically. And then I have a trading portfolio. I kind of have a mock like $30,000 portfolio and $5,000 portfolio. And by the way, the $30,000 portfolio is worth about 50 now, and the 5,000 is worth about 25 since the beginning of the year. Now, I'm just showing how small investors can kind of do this, right? But that's the $27 a month service. And also, if you buy the book and show me proof of purchase, I have a lifetime service for $900 a year, and we'll take $200 off that. Well, you get it for $700. So that's basically it. And like I said, I think the easiest way, even you can go to Amazon and find the book, but if you go to profitfrompessimism.com, we have a link to the book at the top, and then you can read about it. I have something called Stock Chart of the Day, which I do as part of Profit from Pessimism, and I don't do it every day because it's free, but like a couple times a week, I'll talk about, like I just talked about CDNX breakout. I just talked about silver recently. You'll see them on YouTube as well, and you can sign up to my YouTube as well, and then I just do these little 5-6 minutes videos like three times a week or something. I've done less of them recently because I'm doing more interviews like this, and I rather blast these interviews because these are more detailed. So, and whatever, the book is $35, and I think you'll find it. And like I said, I have actionable trades in the book. One thing we didn't talk about today, but we can talk about another time. I actually have a way, if that bond bubble bursts, I have an excellent, I think, low risk way of kind of playing that. And I talk about that in the book as well.
All right, fantastic. David, so great to have you on and get your insight on not just gold and silver and juniors, but all these different topics, very important. People are going to need to know where they can recycle these gold and silver profits, in the next couple of years. Where are they going to be able to recycle them? Well, back into other markets that have crashed. So,
And Jordan, I'll tell you, my ultimate plan is I want to make a bunch of money in gold and silver, like speculations, juniors, those stocks. And then hopefully the market tanks. Then I just want to buy these super high dividend stocks and just basically live off the dividends. Maybe in 3 years, if this works out, you won't even see from me because I'm living off the dividends. I don't want to work no more.
yeah, I forget. I won't say the person's name, but you know who they are. But they told me once, like, yeah, at some point, I hope I'll be living on a boat, and then I won't be talking to you ever again. All
I'll
right,
still talk
buddy.
to you. Me and Jordan love football. Well, next interview, we got to do some football talk.
Yeah, we definitely will. Thanks, David. Really appreciate it. And let's do this again later in the year, see how everything's progressing.
Yeah, sure.
Thank you for tuning into the Daily Gold podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.